Hello everyone. In this particular video, I'll be explaining to you price to earnings ratio and how is this ratio interpreted and utilized in financial markets, investments, as well as some of the other variants of the standard price to earning ratio. So price to earning ratio is generally considered as the most important financial ratio when someone wants to take a preliminary look at a particular company, just not the company, even could could the could be the overall markets as well, to understand the valuations of the market. So P ratio is a valuations ratio which also takes into account rather a set of hidden information in it in terms of the company's performance as well. So how is this P ratio calculated? P ratio is the ratio of price per share to the earnings per share. So the price per share is the current market price per share of a company, of the company. Say any company, let's take an example, Apple Corporation. Apple Corporation's current market price is $100, and earnings per share is the cumulative earnings for the last four concluded quarters. It is also referred to as trailing 12 months earnings, or rather TTM. So let's say of Apple Corporation, for each of the last four quarters, the earnings per share was $5. So the P ratio for Apple is $100 divided by, since it was $5 in each of the last four quarters, the earnings per share with the last four quarters becomes $20. So the P ratio is 100 by 20, which is equal to 5. Since the Now we might ask this question, why isn't the price equal to the current earnings? So price of a particular stock just doesn't take into account the current earnings. Of course, the current earnings is a parameter that is considered, and it's just not the current earnings. It is, as I mentioned over here, price per share is the sum of the current earnings as well as all the anticipated future earnings of this company. And it just doesn't stop there. The price element also includes the overall market sentiment towards this company, as well as the how is this company is performing. I mean, its reputation, its current earnings growth, its the cash in its accounts, its products pipeline, what the management has to offer to the shareholders in terms of how is the company going to perform in the future, as well as the company's corporate governance practices, its reputation. All that is included in the price per share. And just to add, the price per share, one of the major components of the price per share is also the overall sentiments of the financial market. How is the financial market performing? Certain major economic indicators like like the country's GDP growth, inflation, the stability of the government, as well as the global economy and the financial market as well. So all these factors do play a role in the price of a particular stock. And more more the more global the company is, in the sense, more a good proportion of its earnings are coming from international markets, currency fluctuations, as well as the economic performance in those countries also play a role in determining the price per share. The P ratio is also referred to as the price multiples or earnings multiples. And how is this ratio interpreted and utilized? So the P ratio as such a number won't help you understand much. Like, say I tell you that the price to earnings of Apple is 5. It might help you tell that, okay, the market is valuing Apple Corporation at 5 times its earnings, but it has to be looked in terms of certain other parameters, the like the earnings growth of Apple Corporation, and then you juxtapose it with the P ratio and see for what earnings growth is this multiple reasonable for the existing earnings growth. You also look at how is this overall industry doing, and compared to this industry's average PE is how is Apple's PE. Sometimes I mean, it always happens that if the industry average, say for the consumer goods industry, has an average P ratio of 10. Some companies will have an average P ratio above 10, some will have below 10, some might have equal to 10. So companies which generally have a higher P ratio than the industry average do have that ratio, or do command those premium valuations, what you call as premium valuations, so superior valuations, because the company might have demonstrated better earnings growth in just the concluded year or the concluded quarter. Its product pipeline might be doing well. The company is gaining reputation. It could be various set of reasons due to which the company commands higher P multiples, rather higher valuations compared to its peers in the same industry. Now I explained to you the case where the company commands higher P multiples. Similarly, there'll be companies which command lower P multiples compared to the industry. This just could be because the company hasn't been doing well in the past. Its earnings growth is relatively poorer compared to the industry average. Some things are not going good with the management. Or maybe the company is debt laden. So all these factors also do play a role in determining the company's valuations. So PE ratio is a first indicator, and through the PE ratio, you will see, you'll ask a lot of your questions can be answered as to why this company commands such valuations and why not. Say why Apple commands a valuation of 10 and why not 5, and then you always dig deeper into the balance sheets and the cash flow statements and income statement of this company to help understand yourself, to understand the company better. Some investors view low PE ratio as not a bad thing. Some investors do look at a company from a very long term perspective. Generally, financial markets take into account the current earnings and maybe the earnings of the next year, or the years, maybe the next 2 3 years. That's the way a lot of traders view companies. They give a lot of weightage to the current performance, and their behavior tends to be very sensitive to any shocks in the performance of the company. But a set of investors don't worry about a few bad quarters. And whenever the price corrects, they look at this as an opportunity to get into companies, and they view companies with low P ratios due to any reason which I mentioned just now, as value picks. But the company will have to demonstrate over a period of time that it deserves better valuations, and if it does deserve better valuations, the market itself will give it better valuations. Say if it is commanding a P ratio of 5 currently, it might command a P ratio of 10 in future based on its performance. Similarly, companies which are commanding very high P ratio, say twice the industry average, say Apple commands a P ratio of 20, whereas the industry average is 10. So when Apple commands such high valuations, in the succeeding quarters, in the succeeding results that are going to come, Apple will have to demonstrate that it deserves those valuations by showing similar earnings growth. And if it doesn't, then the price is going to correct, and you'll have the P ratio falling proportionately. There are certain other variants of the P ratio. One is the Ford P, or it's also called as the Ford multiples. So Ford multiples, the denominator is not the trailing 12 months earnings. It is the expected earnings over the next 12 months. So this ratio is used when people see that this company's the future earnings are going to be significantly different compared to its past earnings, because maybe some of its projects have done very well and it has got a lot of new contracts. Its product pipeline has become very successful, and due to which good, much healthier earnings are going to flow in. And so if you look at this company in terms of the past P multiples, it might look expensive, but it may not look very expensive in terms of the Ford P multiple. Say the current price is 100 and the trailing 12 months earnings are 10, the P ratio is 10. Whereas if the expected earnings over the next 12 months are 20, the P ratio is 5. So in terms of the past P ratio, it might look expensive, but in terms of the forward P ratio, it may not look expensive. And the other ratio is the PEG ratio, which is the ratio of P price to the trailing 12-month earnings to the expected earnings growth over the next 12 months. So as I told you in the above case, there could be, because of a sudden new information that has just come into the market, this ratio could be below 1, like in the above case which I explained, or it could be above 1 as well. Generally, it's a perception that if the earnings growth is 15, the P ratio also needs to be 15. But it may not be the case due to various factors, maybe, or just could be there is heightened demand for this particular company. So this may not always be the case, but people try to establish a ratio between P and the earnings growth over the next 12 months. So both forward P and PG ratio, they help us to compare the current P ratio with the expected earnings growth. There's one more ratio which a set of investors do take into consideration before they delve deeper into looking at a stock, that is the average P. So there could be companies which have done very well in the last year, or maybe very badly in the last year due to some external reason which is just not company dependent, say a major financial crisis, or something like that, certain uh, commodity price collapse, or certain severe commodity price increase, and due to which just the past year's earnings could have been significantly different compared to what it was in the years prior that. So in this case, taking the average EPS over the last 3 years, or say over the last 5 years, helps you give a better picture of the P ratio of the company, especially when the earnings are volatile. So it's like you control for stability in earnings. So that way it gives you another perspective to look at the company's valuations. So yeah, one is so it's important that you understand why the price is always higher or sometimes even lower than the current earnings. How is P ratio calculated? How do you interpret and utilize the ratio? And some other variants of P ratio which helps you to compare the current earnings with the expected future earnings, as well as helps you to understand the stability in earnings, especially when earnings are not stable or rather volatile. Hope this helps. Thank